In today's video, I'll be analyzing one of the world's largest pipeline and energy companies, Enbridge. As always, I'll start by analyzing what is the business model of this company, so how are they able to generate their income and who are their different customers. And after, I'll make a quick fundamental analysis on the business followed by a price prediction to see if it is currently under or overvalued. Without losing too much time, let's get to it right now. Enbridge is currently in the top 15 of the world's largest oil and gas companies in terms of market capitalization with a valuation of over $100 billion at the moment. As being an energy company in today's world, Enbridge is making the biggest part of its income throughout the transportation of energy and fuel throughout North America. In fact, it is currently North America's largest natural gas utility by volume and the third largest by consumer count. Plus, by operating the world's largest and the most complex pipeline that length over 28,000 kilometers, it moves about 30% of the total crude oil production in North America, and it transports about 20% of the total natural gas consumed in the US. But Enbridge is also a company that is trying to adapt to tomorrow's environment by notably having a net zero gas emission policy before 2050. At the moment, with their 23 wind farms, their 17 solar panels operators, and their hydroelectric facility, their green energy production is enough to meet the electricity requirements of about 969,000 homes. Incredible, isn't it, from a company that only has about 4% of its total earnings that are coming from the green renewable energy branch. As an investor, this is the kind of company that I love to keep an eye on since we will continue to have massive electricity needs in the future, and with the renewable energy turns that we are about to see in the next couple of decades, well, Enbridge is currently in a great position to capture those future opportunities. Despite that, we've seen that the latest earnings report of Enbridge were not as good as predicted, where they notably haven't been able to outperform the prediction of the analyst in terms of the earnings per share, and where they've had a slight diminution in the revenue in the last quarter of 2022 compared to the same period but in 2021. As you can see, the last quarter of Enbridge hasn't been the best one yet, but since the last year, we've seen that Enbridge has been one of the few stocks that has been able to have some positive momentum on the market, which is pretty good compared to the overall market performance. But this was mainly due to the fact that the oil is often considered as one of the best indicators of the inflation, and so it is also one of the best hedge against it. And throughout 2022, we've seen that the inflation was at its highest point since more than 30 years. And for the oil price, we've seen that it was at its highest point when the US were giving sanctions to Russia following the Ukraine war. And in fact, since Russia is one of the world's largest producer of oil, well, this has had a pretty negative impact, mainly for Europeans, which are depending a lot on Russia gas. As you can see, this black gold is still massively needed in our life. It can be to warm our house or also to fuel our car. So Enbridge is one of the best stocks that you can find on the market if you want to prepare yourself for the future opportunities that will come in the green renewable energy sector, but without compromising today's gain from the oil sector. But now, let's see if it is currently worth your money. In valuation terms, we can see that this company currently worth close to $110 billion with a pretty low price to earning ratio of about 20, which is showing that this stock would currently be undervalued compared to the average of the energy industry. Plus, with a fair profit margin of about 5% over the last 12 months, this company has had some quite fair return on assets of about 3% and a great return on equity of about close to 5%. Plus, over the last year, we can see that its total revenue has been of about $53 billion, with some quarterly revenue growth over the last quarter of 2022 of about 7% compared to the same quarter but in 2021. Unfortunately, we can see that this company doesn't have a lot of cash, only about $1 billion compared to its massive debt of about $82 billion. And in terms of the risk of this company represented by the beta on a 5 years period, since its beta is less than 1, it means that it will have less volatility compared to the overall market, and over the last year this has been translated in a gain of about 0.30% compared to the market that has been negative of about 6%. as being considered by many as one of the best Canadian dividend aristocrats, we can see that this company is offering a dividend of about 6.73%, that is a quarterly dividend, which have also been increasing since more than 28 years. But unfortunately, with the same problem that comes with debt, we can see that this company has a super high payout ratio of about 268%. But despite that, in terms of the total revenue, we can see that they have been growing pretty steadily, except for 2020, where we've seen that the pandemic has had a pretty negative impact on the total revenue of this company. But unfortunately, we see that the cost of revenue, but also all the different expenses have been all increasing over the last 3 years, which have come diminish the total net income progression. But we can see that in terms of their cash flow from operating activities, they've been able to increase over the last couple of years, which has obviously had a pretty positive impact on their free cash flow, and it is one of the reasons why this company is still able to give some great dividends to their shareholders year after year. And finally, to determine what should be the true value of this kind of company, I'll be using many different evaluation models to help me out with that. Starting as always with the Peter Lynch valuation method, where you come use the future growth of the earnings per share that you come add with the dividend yield and that you divide with the price to earning ratio. And with all those metrics, we can see that this company would currently be overvalued at the moment. Unfortunately, for the second model, which is the dividend discounted model, we won't be able to use it since the average growth rate is higher than the weighted average cost of capital of this company. And finally, one of the best models that I'll be using at the end is the discounted cash flow model. And as its name is saying it, I'll be discounted all the different free cash flow of this company to see what is the true value of this business. But the first thing that you need to find first is the discounted rate, which will be our weighted average cost of capital, where you will start by finding what is the cost of debt. After, you'll find what is the cost of equity. After, you finally find the cost of debt and equity, which will give you your weighted average cost of capital. And with all the different criteria that I'll be entering in that formula, we can see that this stock would currently be a buy, which would obviously mean that on that side, this stock would currently be undervalued. As you've been able to see in this video, Enbridge has a quite interesting business model on the long term, especially knowing that this company is preparing for tomorrow's environment while keeping the massive potential of growth from the oil industry, which is another great way for you to protect yourself against high inflation. However, as you've been able to see, 2 out of the 3 valuation models are saying that this stock is currently overvalued. But despite that, this stock is considered by many as one of the best Canadian dividend aristocrats that you can find on the market. That is providing a great 6.5% of quarterly dividends, which has been increasing since more than 28 years. All of this despite a super high classical dividend payout ratio. So it is basically a stock that you can basically buy and hold forever and forget about it and just harvest the fruits of those high dividends. But on your side, if you want to see what are the best and the most undervalued Canadian dividend stocks at the moment, well, check out the video that's gonna be right over here, and I will see you soon. Peace!